Welcome to another episode of Map Your Money. My name is Arash Narani, and I'm a wealth advisor and certified financial planner here at Benedetti Gooser and Associates. And today I'm joined by another wealth advisor and certified financial planner on our team at Benedetti Gooser and Associates, Heather Gardner. It's been a while since we've had you on the podcast. How's it been going?
It's been going great. Thanks for having me today. Nice to be back.
Of course. Yeah, we're very, very happy to have you back. I know we usually start with some sort of icebreaker, and so it's springtime, which means great weather, but it also means pollen. Do you get any allergies or anything like that?
There is an excessive amount of pollen, but I do not get allergies, just the annoyance of the light green, yellowish haze everywhere.
Oh, yeah.
That coats everything in the same color.
Definitely. That's probably my biggest frustration with pollen. So I guess I'd consider myself blessed that I don't have to deal with allergies. But like car washes are just not worth it all spring unless you're getting one every week. My car is just bright yellow. So
yeah, 'tis the season.
Oh, yeah.
Everything matches.
Oh, yeah. Definitely. Well, let's get into it. We have an awesome topic. So we'll get right into it.
Hello, and welcome to Map Your Money, a finance-focused podcast. We exist to simplify the lives of our clients and listeners and help individuals create the roadmap for their financial future. Content is for educational purposes only. Consult a financial advisor or conduct your own due diligence of investing. Calls are pre-screened and the content was pre-recorded.
All right. Like I mentioned, we have an awesome topic today. Wanted to bring Heather on because I know this is something that matters a lot to you, and you talk to a lot of your clients about it as well as for me. I think it's something that's really important and something that I love to talk to my clients about in terms of working with people who are philanthropically oriented or want to give back into the community or for different charities and all of the interesting financial ways to do that and kind of save on taxes, and kind of improve your overall financial situation. There's a bunch of different things that we'll get into, but I guess a great place to start is whenever you're kind of giving back. There's a couple different ways to sort of give, and so you want to kind of touch on those, Heather?
Sure. So Americans overall have gotten just increasingly philanthropic over time, both with money and time and volunteer resources as well. So there's several vehicles that you can use to give of your financial resources. So if you have an IRA and you're in that stage of life where you are taking money out of an IRA, you can do qualified giving directly from that, which is a tax advantage. You can obviously just give from your checkbook or your credit card as cash gifts, which is probably the most common way. It's not the most necessarily financially efficient way, though. There's other vehicles. You can set up a fund called a donor advised fund that can really help with tracking, and it also has some tax components that are special about it in the year that it's given. And then and within that, you can gift highly appreciated assets. So if you think from a taxable standpoint, say you have some stock that you've had for a long time and it's gone up in value a lot, you could sell it and give some money to an organization of your choice. Yeah. But then you pay taxes on that gain. And there are vehicles where you can just give the value of that asset to the organization of choice so that it's a win-win. The organization gets more and you don't get any less. You still get the gift.
Yeah, definitely. And we're going to break all of those down. So I know you mentioned the QCD, that qualified charitable distribution from the IRA, the donor advised fund. That's kind of more of the financial planning savvy ways to give. And we're going to jump into those. But I think we should start with cash and volunteering. Those are the most common, the ways everyone thinks of, like when they're giving back. It's, they're using money from their checking account, or they're using money that they have, and that's the way they donate, or they volunteer their time and use their time. And so unfortunately you can't deduct your time. I know we're right around tax season right now recording, Unfortunately, you're not able to deduct your time that you give to an organization or for volunteering, but you are able to deduct money that you give. So most people are aware of this in terms of when they're giving to an organization, that when they file their taxes, if they report that or include that, then that can be tax deductible. I think one thing that people sometimes overlook is they're saying, okay, I'm giving to XYZ Corporation and this year it's tax deductible. I'm going to get this benefit. It's going to bring my taxes down, which I think is an oversimplification because a lot of people use the standard deduction now, that standard deductions for single, married, filing jointly, all of the different tax ways you can file have severely increased over the last few years. Can kind of talk about why that's been, but I guess the why that's been has just been to give the IRS some more ability to get through all of the taxes and kind of take some stuff off their plate. But if you give, let's say, $2,000 to an organization in a year, but you are still using the standard deduction, you're not going to get any tax benefit from that when you file your taxes. Am I understanding that correctly, Heather?
That is correct. So when you file the standard deduction, you forego an itemized, and charitable donations are an itemized deduction. It's still great to give the gift to the organization, but you may not be getting the benefit from the tax standpoint that you're expecting in that when you do it in that way.
Definitely. And I think that's kind of something people are like, oh, I'm giving to charity. The charity's definitely going to tell you it's tax deductible if it is. And they're going to use that as a benefit. And we're not telling not to donate to charity, but it's something that you should be aware of. Maybe it makes sense to talk to your CPA. And if you're giving $3,000 a year or something like that to charity or whatever number it is, and you're always using the standard deduction, maybe instead of giving that donation around Christmas time, you wait 6 days till January 1 of the next year, put that $3,000 donation and then do another donation that you were going to do at the end of the year. So then you have both in the same tax year. And then maybe then it makes more sense to itemize and you get a bigger benefit than your standard deduction. And so there's ways to tax plan around it. It doesn't work for every scenario, but I think it's something that's really important and kind of overlooked there. But any other points on either cash or volunteering, Heather, before I jump to QCDs?
No, that's great. That's the most common way, like you said, and it may not be as transparent on the tax side as everybody thinks.
Definitely. And so with QCDs, these qualified charitable distributions, the way these work is for individuals with a 401k or an IRA, this pre-tax vehicle that they've saved into throughout their career that they have, there's required minimum distributions on these accounts. Most people are aware of this. And once you hit the age right now is 73. And so once you hit age 73, you are required to start taking money out of your IRA if you haven't already. You've already started taking money out of your IRA. You still have this required minimum distribution. You have to take at least this amount at 73, 74. Just touching a little bit on RMDs. It's basically a divisor table. And so it's a percentage of your IRA that needs to be taken out each year. At the beginning, it's a really small amount, I think around 3%, maybe a little bit less. And then each year it increases and increases and increases. The reason RMDs are a thing is because the IRS hasn't gotten their money from this money yet. You took it out pre-tax. They were never taxed on it. So Uncle Sam never got his piece and it's grown in this tax deferred account. And you still haven't touched it. Okay. They put this in place. So you have to take that money out so then the tax man can get paid. And so makes sense from their point. But a lot of individuals have a situation where they don't necessarily need that money, or they have other funds that they want to be pulling from, or they are already charitably inclined. And rather than giving from a checking account or elsewhere, instead of taking this money out as a required minimum distribution from their IRA, they just send it directly to the charity as a qualified charitable distribution, and thus don't have to recognize this as taxable income in that year. You want to elaborate a little bit on that, Heather? How'd I do?
It's a great advantage. And tax deferred from the IRS standpoint does mean deferred. Like you have to eventually do it. So if you have been given a specific number, which is what you get with a required minimum distribution, it's an exact dollar amount calculated by the IRS. But say that is $5,000, like $5,512 for an individual. If they normally give $6,000 of charitable giving every year, they can do that directly from the IRA. So it cannot come to their checking account and then go to the organization. It goes directly. And then it's not recognized as taxable income to the individual, and the organization gets the benefit.
Exactly.
So the only thing that's different is that tax isn't paid on that distribution. So it is a very, a very nice planning tool.
Definitely. And in that scenario, that 5,512, the other alternative is they take that out from their IRA. They have to then pay ordinary income tax on that at whatever tax bracket they're in. So then that severely, that would decrease by whatever their tax bracket is. And then they're giving that 6,000 from their checking account anyways. So why not keep that 6,000 or add the 500, keep the 5,500 in your bank account, and just move that money straight from the IRA, not have to pay taxes on that, and send that directly to the institution you're involved in or care about. It's an awesome way to kind of save on taxes and fulfill that required minimum distribution through a philanthropic effort.
Definitely. You can also do it to multiple organizations. Sometimes we get that question. You can do it as many organizations as you want to, as long as it's direct from the tax deferred account.
Another important consideration while we're talking about QCDs is that you're unable to get a tax deduction when you do this. I know we just talked about the tax deductions, and if you're itemizing your taxes, you're unable to say, oh, I made this $5,512 donation. I want this to be itemized within my taxes. The reason is because you're already getting the tax benefit. You're already forgoing the taxes that you should be technically have had to pay there. So one tax benefit, not two, but one. Exactly. It's still one, and it's still very, very advantageous there. So important to look at that as well. I know we kind of alluded to the donor advised fund, and that was the bulk of what I wanted to talk about. I know I'll kind of geek out on the donor advised fund. So I'll let you kind of set the stage though, Heather. What is a donor advised fund? I know you mentioned a little bit earlier, but what is it, and how do you most oftenly see it be used?
A donor advised fund is a vehicle for charitable giving that allows a lot more flexibility than when you do it directly. So an individual or a couple can donate to this designated fund, and then from the designated fund, make grants to various charitable organizations. So there's some specific situations where it can be a really good idea. One of them you kind of already alluded to, Arsh, is if you want to sort of stack charitable donations over a couple of years. Say you want to itemize your taxes, the year in which a donor puts money into a donor advised fund is when it counts for your taxes, but you still have the flexibility to wait to distribute the money if you want to. You can give it away immediately, or you can pause for a while, and even within the donor advised fund, it can grow, it can be invested. Yep. So your charitable legacy could actually build. The timing of it can be particularly advantageous for if somebody gets just have a particularly large income year. So maybe you get a big bonus, maybe you sell ownership and part of a company, and you're going to have this really high taxable income for a certain tax year. You can carve out and make a donation to your donor advised fund, and then distribute them over time if that's what you prefer. You can get all of the tax benefit in the year that it's done.
Exactly, and that's a great point, and kind of comparison I like to make with the donor advised fund is comparing it to like a private foundation in a way. That's not the only way a donor advised fund can be used, and most oftentimes isn't. But if you kind of think of, say, maybe it's a goal for you or your family or something like that to start creating this philanthropic legacy and having this money grow over time, you're able to use a donor advised fund very similar to how a private foundation is used. However, the benefit compared to a private foundations have a ton of different requirements, filings that you have to do each year. You're required to distribute 5% of the account each year for a private foundation. None of these requirements are used in the donor advised fund. So you can say, hey, maybe I want to save X amount a year or a portion of my salary each year, but you don't know where you want to direct that yet. Maybe you want to just get that invested and have that grow. And so let's say 10 years over time, you contribute into this donor advised fund, get that money invested. Each year you contribute, you're getting that tax benefit if you're itemizing your taxes, and get that tax deduction. So you're taking the benefit there, but then you're having all of this money in this account grow over time. And then you can take it all out for one big sort of philanthropic project or something like that. It has to go to, I believe, a 501c3 organization, but there's kind of ways to, I think, give directly as well. You'd kind of have to talk to someone that's running that donor advised fund account for you, but a lot of unique ways of kind of having this money put aside and grow for either you, your family, to make some sort of charitable impact in the future.
Yeah, I think that's a great point because it can create this sort of legacy and multi-generational thread. We've seen situations where maybe the grandparent generation funded the donor advised fund, but they have the grandchildren involved in choosing where the money can go. And it's a real link between those generations and having those discussions. And it's a good practice for the younger generation to make decisions about, what causes to support and what's important to them.
Yeah.
You can name your donor advised fund. There's a lot of flexibility. If you wanted to name it a foundation name, you can do that, or you can name it whatever you want to. If you wanted to give anonymously, sometimes that's important for people, and that can be done in a donor advised fund, perhaps easier than if you were writing it out of a checkbook.
Yeah. And I mentioned kind of using it like this isn't necessarily the most common, and want to talk about one of the most common uses of the donor advised fund. And it's because of its really tax advantage status. So some charities will allow you alluded to this right at the head of the podcast. Some charities will allow you to donate your stock directly to them, but that's not always the case. So what a donor advised fund allows you to do is, let's say you bought Apple for years and years and years, or you worked at Apple or some corporation, and you have this really low cost basis stock. So here in Atlanta, I have a lot of clients who have really low cost basis stock in Coca-Cola or Home Depot or Delta, because these were the up and coming corporations, or they might have worked there and gotten this as a benefit. But now they have all of this stock in a taxable account. So let's say it's $100,000 worth of Coca-Cola stock, but they only paid $10,000 for it. If we sold all $100,000 now and tried to diversify that position, they would take a $90,000 capital gains hit. If these people are charitably inclined or already giving to charity, one of the best advantages of this donor advised fund is that you're able to move that money into a donor advised fund. Let's say they are already giving $20,000 to charity a year. And I'll kind of make it an extreme example so we can quickly get to that 100,000. But let's say they're already giving $20,000 a year. Maybe instead of doing that $20,000 donation each year from their bank account, we're going to move this $100,000 of Coke into a donor advised fund, liquidate it. They'll get all $100,000 of that benefit in 1 year. So they're able to take this massive tax benefit in 1 year, and then just parcel out $20,000 each year like they've been doing for the next 5 years into these organizations. And they could even invest that money over that period of time and maybe create more value and maybe have another year of $10,000 or $20,000 that they're able to donate. So Truly an awesome avenue to be able to give back, and especially for people who are already giving that have this highly appreciated stock. It's truly an incredible vehicle to be able to maximize your tax benefits and your overall financial situation.
You think it's a great vehicle? It really is a double win, just like the QCD. That you as the donor get to be really impactful, and the organization receiving the donation gets the full donation. And the main thing taken out is the tax burden. So it is really a double advantage.
Yeah.
Donor advised funds also help simplify the administration of your giving, which some people think is a huge pro. For people that give to a lot of different organizations throughout the year, and they do itemize their taxes, you end up with a lot of receipts and a lot of tracking. The donor advised fund just encapsulates all of that and makes it so much simpler and easier.
Definitely. That's a great point as well. And it's kind of all tracked in a way through the fund. You still want to kind of keep your receipts, but it's another way of tracking the donations or the contributions you might be making. Another point I wanted to make here before we wrap up is I know some people who are giving or they give through a checking account or however they might give, think, oh, if I give them highly appreciated stock, or if I put it into a donor advised fund and sell it and then give them that money, or a QCD from my IRA, that's going to be harder for Red Cross or whatever organization to take that money and then use it. It is not. I've talked to people at these nonprofits. They have this tax advantage status to be able to make any sales if you give them a highly appreciated stock and not have to pay a penny. It's the equivalent of giving that cash value. As soon as they receive it, they're going to liquidate it, and then they have that cash on hand. So I think that's important to recognize as well.
Yeah, there's an advantage from their side, and they're used to it. Donor advised funds are very accessible as well. National organizations can run them. Local organizations. There's a community foundation of Greater Atlanta. And in most cities, there's a community foundation type setup, and the firms that we work with do them within their platforms as well. So they're very accessible. It's just a matter of choice and preference and management.
Definitely. And one of the things I love about the donor advised fund is the flexibility. Like, you can give into it each year. You can put in appreciated stock into it each year and then just donate it immediately. Like, you're just kind of giving straight to it. You can keep it in there for a year or 2 years, let it grow, give it all out in 1 year. You can treat it like this is going to be some sort of fund that you want to keep on forever. You're contributing to it. And maybe you treat it like a retirement fund, and you take out 4% of the account each year. So you hope that the account continues to grow into perpetuity forever, and that you're able to take this money out and donate that each year. So there's a ton of different options and flexibility in there. You have a ton of flexibility in how you get that money invested as well. You can, depending on the organization you're going through, you can put it into just a money market to where your money's not really going to decline in value. You can invest it super aggressively in stocks or have a mixture of stocks and bonds. A lot of this depends on how much is in your donor advised fund. I know I've worked with Greater Horizons as an organization that runs some donor advised funds, and below $100,000 in the fund, you have to choose one of their 6 pre-selected funds, which have a ton of different options and are great investment vehicles. But above $100,000, you can actually use your investment advisor. So if you're a client with us or work with us, you can say, hey, I love y'all's models, the way you think about investing in all of this, and I have $250,000 that I want to put into this donor advised fund. We can put that in to a donor advised funds with our with a portfolio that's tailored to you and what your goals are for this fund. If you want it to generate a bunch of income and have these dividends, or if you want it to just grow over time, and we can have that conversation, or whoever your advisor is. So again, the flexibility and the options in there are truly incredible.
All right. It can be so impactful. I mean, I've seen people get more excited about their donor advised fund growing than necessarily they have their retirement account growing, because it really feels impactful. And there's so much that you can do with that once you have it, kind of started and organized and set up to use.
The very last point I would make on that is related to the exact same point about the impact. I've worked with a lot of clients who we go through a retirement plan, and they have a very, very high probability that they're going to be able to meet all their goals. And we actually flip this. We think this is kind of something we need to address. It's not like, oh, okay, you're good for retirement. You have a 99% probability of success. We don't need to worry about anything else. This often means you could be spending more in retirement, or we could be using more aggressive retirement goals, like an earlier retirement. And if not, that means that if you're not interested in that, you're already in retirement, or you don't want to retire earlier, you're going to have a lot of money that's going to pass somewhere. And so some people want that to go to their kids. Others want it to go to some sort of charity, and they're very charitably inclined. But they're like, just at the end of my plan, I can give it there. I would argue, if that's the case, it's one of the best parts about giving to charity and giving back, as selfishly as it sounds, is being able to see that impact, being able to be alive and really see, oh, okay, I did this, that, or the other, and it's selfish, but in a way, but it's part of the reason giving is so great. And so being able to see that impact or see what you're able to do while you're alive and take the tax benefits of doing so. And so kind of looking at something like this as well.
You're right. There's a joyfulness in seeing what your gifts can do versus not seeing it if you're no longer here and your gift may be impactful, but you don't get the joy of seeing how that really plays out. And most organizations would have needs right now.
Mm-hmm. Oh yeah. That's an even better point to make. You're going to see something that is near and dear to your heart that's going on right now. And maybe you don't want to wait 20 years before you have to give all of your assets. You want to give now. And so that's a good point as well. Heather, thank you so much for joining us here on the podcast. I love to talk about the topic of philanthropy and charitable giving strategies and don't often get to as much as I'd like to. So appreciate you coming on the podcast and giving us your thoughts.
Yeah, it's great to be here. Donor advised funds and QCDs are a great, efficient way to really maximize your impact and your kind of charitable footprint. So, we got to discuss it in more depth.
All information provided by this presentation is for educational purposes only and does not constitute investment, legal, or tax advice. It is not an offer to buy or sell any security or any insurance product. This is not an endorsement of any third party or such third parties' views. The information contained herein has been obtained from sources we believe to be reliable and is not guaranteed as to its accuracy or completeness. Whenever there are references to third-party content, this information is intended to provide additional perspective and should not be construed as an endorsement of any services, products, guidance, individuals, or points of view outside of Benedetti Gooser & Associates and Beam Wealth Advisors. All examples are hypothetical and for illustrative purposes only. Benedetti Gooser & Associates and Beam Wealth Advisors do not offer tax or legal advice. Interested parties are strongly encouraged to seek advice from qualified tax and/or legal experts regarding the best options for your particular circumstances.